Welcome to Exchange Traded Fridays, brought to you by ETF.com. I'm Sumit Roy, Senior Analyst here at ETF.com, and I'll be hosting today's episode. Since our usual host, Paul, is off this week, he will be back next week. Anyway, we got an exciting episode lined up for you all. We're going to be talking about crypto, leveraged ETFs, Ray Dalio, Warren Buffett, and even copper. Yes, it's a very wide range of topics. We got a lot to cover, so stick around. All right, so Ron, I want to start with you because you wrote two very interesting articles this week. The first one was titled Crypto ETFs Unstoppable Move into the Mainstream. What was that about? Was that just a continuation of what we've seen over the past year and a half since spot Bitcoin ETFs launched? Or is adoption accelerating in some way?
Yeah, I mean, we've just been seeing a complete reversal, I guess, from the days of Sam Bankman-Fried, right, and FTX and Binance, where a lot of the skepticism in crypto appears to be dissipating, and a lot of that benefit appears to be going to the exchange-traded funds, right? I mean, IBIT has brought in close to $60 billion since it launched. And now we've got suddenly the spot Ethereum ETFs are kind of catching up. I know, the price of Ethereum is still below its all-time high. Who knows how much longer that's going to be, right? I think it's $4,200 or something like that. It's all-time high. I believe it passed 4,000 for a little bit. And really it's being helped a lot by the Trump administration. And I would say there's also some kind of folks like, you mentioned Ray Dalio and Rick Edelman. People are seeing, again, the theme is moving into the mainstream. Some of the fear maybe is kind of evaporated. So Ray Dalio, Rick Edelman, people are saying, you should be allocating double-digit percentages of your portfolio to crypto ETFs. So again, a big cheerleaders in the White House and in the Securities and Exchange Commission. We have in-kind creations and redemptions were approved this week, so which means authorized participants can remove or add assets and use crypto like they did with cash. So I mean, this is a real validation, a real almost like a normalization of something. I mean, how long ago was it that somebody used 10,000 Bitcoin to buy two pizzas, right?
Yeah.
It's crazy.
Yeah.
So, but we're talking to, or we had a few quotes in the story from people who are just saying, this is the future looks, or the next few months are looking very good. The SEC is very friendly. I mean, it doesn't seem like they're maybe trying to thread the needle a little bit between like the Gensler years, where Gensler, I guess, was a crypto expert, but he was also very, very cautious. I don't know who was telling him to be cautious. Maybe that was his own, or there was administration, people in the Biden administration were feeling they didn't want to have another Sam Bankman-Fried. Still, it's a bit of a sea change. And, I did wrap up my piece by saying that the big change, there are some big holdouts, right? What's the biggest one, right? Is Vanguard. Maybe that will be the big signal that it is something that, mom and dad, a plain vanilla type of investment at that point. But the Vanguard CEO is not showing that he's really ready to move that way.
Yeah. And, a natural question, or one thing I should say that I've been surprised about, Ron, and I'll toss this to you or anyone else who wants to answer, is how much of the demand for these crypto ETFs have been directed specifically at the iShares products? Because I'm looking at US spot crypto ETF inflows this year, $27 billion year to date. Of that, 26.2 billion is into IBIT and ETHA, both iShares products. So these are pretty much soaking up all of the demand for spot Bitcoin ETFs. Whereas last year you saw kind of the smaller ETFs get some inflows. This year, it's just been those two, basically.
Yeah, yeah. They have the almost like the late mover advantage, right? They
Yeah.
were not jump in, if I recall, during the whole filing process until the last minute. We had all those other firms that were putting in their applications, what, like 8 years ago, nine,
Yeah.
10 years.
Yeah.
And I guess BlackRock's strategy was to like let them sort it all out, get the bodies cleared away, and then they jump in.
Yeah.
And
It's been incredible. So, Ron, you also wrote another interesting story where you touched on the surge in leveraged ETF launches. There's some pretty crazy numbers that highlight that trend, isn't there?
yeah, just massive amounts of money going into this and huge numbers of launches. Year to date, there's been about 450 ETF launches, and a quarter of them are leveraged ETFs. Now, I don't know. I might have it in the piece somewhere, but like what actual percentage of the $10 trillion or $11 trillion in ETFs are actually held by leverage? But it's a small portion. At the same time, issuers are going all in on these, and it's kind of hard to ignore things like EQQQ, the ProShares leveraged fund, gaining 67% over the past 3 months. It's kind of hard to ignore that. So people are jumping in, and Sumi, one thing, and I don't know if Kent's got some thoughts on this one, but we are kind of seeing some crazy signals in the market right now. I'm writing a little bit about income ETFs today and how I would imagine you'd think of income ETFs as a flight to safety, right? And Vanguard and BlackRock, everybody's lowering their 10-year outlooks for stock market returns, like down real low, 2, 3, 4, 5%. But here's the contrarian move. I mean, people are still saying, well, the market's still got some gas. Let's jump into leveraged. So
Yeah, and you asked Ron how much is in leverage. I just looked it up. $150 billion is in leveraged ETFs out of the 12 trillion that's in US listed ETFs. So a little over 1% of total assets,
and
even though
23% of launches, yeah.
yeah, so even though they get a lot of attention, they're still quite a small portion of the total assets. But I should say, when it comes to the issuer side of things, these are some of the most profitable products on the market because their expense ratios are much higher than average. Sometimes they could be 1% on some of these leverage
Yeah.
ETFs. So you could see a leverage ETF that has a fraction of the assets of this big, broad index fund, but it's actually much more profitable for the ETF issuer, which is kind of interesting.
Yeah. And of course, we focus so much on the leveraged ETFs that focus on companies, right? And it looks like that's a very fertile or very green field right now. I mean, even
Yeah.
new, smaller stocks like New Scale and like more conservative stocks like JP Morgan, they're all getting this single stock leverage treatment, which seems kind of crazy. But at the same time, I guess the leverage really started out with indexes, right? Get the, like
Yeah.
TQQQ and things like that. So it seems like the market's got a lot further to grow. And there was a comment from Balchunas the other day said, a lot of these are just they're gonna die on the vine, but there should be enough that the issuers will wring sufficient income out of themselves.
Yeah. Yeah. I think it's a matter of people just throwing stuff out there, seeing what catches on. And yeah, TQQQ, it's been around a long time, $28
Yeah.
billion in AUM, still by far the largest leverage ETF, even though we talk about the single stock ones. Though one day maybe a single stock one will get up there. I'm looking TSLL, the Tesla fund has 6.2 billion in AUM. That's the biggest single stock fund, but still
That was the first one, wasn't it?
TQQQ, was that the first one? I wouldn't be
The first
surprised.
stock, I mean, the first single stock I thought was
Oh yeah, yeah. The Tesla was the
22.
first one, though I don't think it's the direction one. TSLL is direction.
Oh,
There was
oh, oh.
another Tesla single stock ETF. That was the first one. I forgot what the ticker on that was.
Yeah. Yeah, the inflows are insane.
Yeah, absolutely. Absolutely. So now I want to move on to Kent because you also wrote two interesting stories this week, but focused on very different topics. They were about two legendary investors, Ray Dalio and Warren Buffett. Let's start with Dalio, Kent. Why was he on your radar?
Yeah, right. Well, what I wrote about is his call to increase his own allocation, investment allocation in gold and Bitcoin to 15%, whereas prior to that allocation, he was at 2%. So that's a major red flag there. Dalio, for those not familiar with him, is well known in the investment community as the successful Bridgewater Associates hedge fund manager, but he's also a widely respected macroeconomist. And what are you saying on another podcast was over $37 trillion in national debt and growing now. And so Dalio is warning that traditional market participants may be underestimating the risk of a currency devaluation and a potential monetary policy spiral. So in translation, the warning is a move away from what economists call fiat currency, like the US dollar, and into safe havens like gold and Bitcoin. So, and also Ray Dalio is not some, perma bear, always, sky is falling type of a guy. He's a pretty measured, intelligent, well-versed person. So definitely worth listening to. And the other kind of red flag that I was writing on was the so-called Buffett indicator. I don't think he coined the term, but other investors did. How that works is if the stock market's value is significantly higher than the GDP, gross domestic product, it suggests that stock valuations are stretched relative to the underlying economic output. So what it's telling us now is as of this month, well, toward the end of July, the Buffett indicator is hovering around 200 to 213, which is significantly above its historical trend line and near multi-year highs. So this level strongly suggests the U.S. stock market is overvalued, signaling that future returns may be lower and the potential for a correction is elevated. And so again, these investment legends aren't just say the everyday perma bear. These are investors who have been around for a long, long time. They watch markets and economies all the time. And so ETF investors are at least wise to pay attention, although, coming from the investment advisor perspective of myself, not necessarily a reason to change your long-term portfolios, but, if your technology allocation is probably through the roof right now with these elevated performances lately, and even today, which is Thursday, the day before everyone's hearing this, Meta, Microsoft are making like 10% moves, which is like $300 billion in market cap. This is just really crazy stuff. And going back to when I first started as an advisor back in 1998, whenever I see this type of stuff, crazy information, high valuations, unusual type investment products coming out, it's a flag, a major red flag. And like Ron was saying a few minutes ago, talking about valuations and other investors looking at value and income. I looked at the VOO, the Vanguard S&P 500 Index ETF, averaging 13.6% 10-year annualized returns. If you're not monitoring markets, I can tell you that that's pretty crazy. And if you believe in reversion to the mean, it's going to have to come down at some point. We just don't know when. So.
Yeah, definitely the performance of the market has been very strong historically. I want to go back though to Ken, what you said, Ray Dalio, 15% gold, 15% Bitcoin. That was what he's personally doing, or is he suggesting other people should do that as well?
Well, that's a good question. He has this all-weather philosophy, which is kind of where assets should be, and there is an ETF for that. Let me go back. The SPDR Bridgewater All-Weather ETF, ALLW. And so that's an investment framework that he follows that emphasizes diversification across economic regimes. So I don't have any evidence that Dalio's personal money is there. Maybe it is, but his philosophy says that you should be heavier weighted in gold and Bitcoin. And the largest ETFs in that space, GLD and IBIT, respectively.
Gotcha. Well, this is a really interesting topic because, there are a lot of people out there who are worried about certain things in the macro economy, and they have been for many years, debt levels, things like that. But on the other hand, you have, like you mentioned, the stock market that's just continued to go up, climb that wall of worry. So a lot of investors, especially those that are more pessimistically inclined, they have to kind of reconcile that in their mind. They can't get too bearish because you end up missing these huge rallies in the market. So I think this is a important topic. You can have certain opinions about the economy and the macro outlook, but ultimately it's very difficult to predict what's going to happen with the economy year to year, let alone the stock market. So as you mentioned, you kind of have to stick with your long-term plan,
Right.
and things like that. I guess for people who are worried, they can increase their allocation to certain assets, whether it be crypto, gold, that can help hedge against things if, the macro outlook is as dire as people like Dalio say. Is that essentially what you tell your clients? If they're worried, they can buy these sort of alternative investments, things like that?
At a minimum, we'll recommend rebalancing. If you have a typical portfolio, maybe say a core and satellite structure where you have, say, a core S&P 500 index fund, and then you might have some satellites around it. One popular satellite is technology sector. And so you've got a lot of overlap there. Your technology and the S&P 500 are both really, really high right now. And so if you have a traditional allocation of, say, I don't know, 70% stocks, 30% bonds, where your stock allocation is way overweight right now. So at a minimum, let's rebalance and go back to our target allocations. We're still holding for the long term, but we're watching our risk.
Yeah, that makes a lot of sense. Great. So that brings us to our final topic. DJ, you wrote kind of a breaking news story late on Wednesday because all of a sudden, out of the blue, we saw copper prices just plunging. I think it plunged something like 20% within minutes. What happened there? What caused such a monster move in copper?
Yeah, so yes, copper prices indeed took a major hit yesterday, and they're still falling today. The United States Copper Index Fund, CPER, dropped at the time that I was writing the story, it was down about 18% following President Trump's announcement of a 50% tariff on certain copper imports. It's now down more than 24% over the last 5 days. And as of today, it's down about another 4%. So this all kind of happened after Trump signed a proclamation targeting semi-finished copper products. So that includes things like rods, sheets, wires, and tubes, and also copper heavy items like pipe fittings and electrical component. These tariffs are all set to take effect August 1st. So I guess when you first look at it, this kind of policy might seem bullish for copper prices. And that's sort of how the market reacted earlier in July when Trump first floated the idea. US US copper prices surged ahead of the expected tariffs, and there were traders rushing to bring in products before the deadlines, and houses in places like Baltimore and Detroit were filling up. But when the actual policy dropped, it wasn't as broad as many people expected. Raw copper materials, things like ores, concentrates, they were left out. So that kind of caught a lot of people off guard. So people who positioned themselves for a larger copper crackdown were kind of overexposed at that point. So, by Wednesday prices had dropped, and it was the biggest drop at least since the 1960s. And I saw that fact in Wall Street Journal. The fund has been doing pretty good this year. It's up nearly 40% year to date before this, but the tariff shock has erased a large chunk of those gains almost overnight. The White House says the goal of these tariffs is to protect national security. And copper's played a major role in defense systems, infrastructure, and electronics, but the U.S. still depends on imports and has limited refining capacity. So the near-term effects of these tariffs likely isn't going to jumpstart domestic production. It's just to raise costs for manufacturers, it seems. And if you look at the flows for CPER, you can see that the year to date, it's been pretty strong, nearly 28 million. Over the past month. There's been a shift, though. It's seen about 10 million in outflows. So I guess it looks like prices are now back in line with global benchmarks. And now that the tariff scope has been clarified, the market seems to be recalibrating a bit to that.
Yeah. I was looking at the US copper price versus the London copper price. And earlier in July, the premium for US prices got as high as I think 31%. Now it's down to zero. All of that premium wiped out. And like you said, DJ, it just comes down to expectations. There was expectations that pretty much all copper imports into the US were going to get hit by that massive 50% tariff. But as it turns out, that all those less processed versions of copper, like the ore and the concentrates, those aren't going to be tariffed at all. And those make up the majority of copper imports. So effectively, most copper imports aren't going to be tariffed, as opposed to expectations where everyone thought that every copper import was going to get hit by that 50% tariff. So big difference between what the market expected and what actually happened with Trump. But we'll see, whether this is, the final word when it comes to copper or not, because I've been reading news reports that the Department of Commerce might put delayed tariffs on those less processed versions of copper, with tariffs starting in 2027 or 2028. Of course, that's a long time from now. So in the meantime, I don't think we're necessarily going to see another big push up in that US copper premium. We'll keep a close eye on this, but thanks, DJ, for that rundown. And thanks to all our listeners for tuning into Exchange Traded Fridays. Remember, if you haven't already, subscribe and follow us wherever you get your podcasts. And if you have a question or you want to share your thoughts, join the conversation with us on X. Our handle there is ETFCOM. Catch you next week.